Hello. So I'll be doing the session 12 assignment. Okay, so it says assignment overview, deliver a full valuation of Panera Bread for perspective, KKR, take over using driver, combined DCF, creating comps and precedent transactions to produce an informed bid range while contrasting financial buyer discipline with strategic buyer synergies. So the deal snapshot is we have a scale of six billion revenue that's growing at 8% with $900 million EBITDA with 15% margin and 400 million net income across 2,100 stores and digital sales, which already reached 50%. And market references is industry P&E of roughly 22x president EBITDA multipliers, 12 to 15x. Chipotle trades at 35x PE, McDonald's at 25x. Capital assumptions, industry WACC 9%. Management wants 10% rollover. Strategic bidders, which are Starbucks, McDonald's, are circling growth levers. 500 new stores in 5 years. Digital mix to 70%. Dinner catering expansion, early stage international rollout. And so I made a Google slide, and let's just begin. Okay, so we first start off by looking at our agenda, and our agenda is to define, discover, represent, implement DCF comps, precedents, validate, evolve bid strategy, and the final recommendation. Define and discover the gate critical. So the objective is value Panera for KKR versus strategic buyers. And some information that we were given is the 6 billion revenue is grown, which is grown at 8%, the $900 million EBITDA with 15% margin, 2,100 stores, and the 50% digital sales, and then management targeting 10% rollover. So some key value drivers are the 500 new stores over 5 years. There's digital penetration expanding to 70%, and there's dinner and catering growth, and early international expansion or expansion. Represent valuation plan. So the plan is multi-scenario DCF, which has three different things with the base, upside, and downside. And there's a trading comparables analysis, president transaction analysis, football field valuation synthesis. So the DCF assumptions is the revenue growth 8% tapering to 5%, the EBITDA margin 15% to 17%, with the CAPEX at 5% of revenue, a tax rate of 25%, WACC of 9%, terminal growth of 2.5%. And so what we get from that is the results of a downside EV of roughly $6.5 billion and a base EV with approximately $8.6 billion, upside EV of $10.1 billion or roughly $10.1 billion, which is a conservative valuation excluding synergies. So some trade comparables are we can look at the peers like Chipotle, McDonald's, Starbucks, Yum, RBI, the EV to EBITDA range of 13x to 16x, the implied, and then in Panera there's the EV of $11.7 billion to $14.4 billion. The present transactions, recent QSR fast casual buyouts, the EBITDA multiplies 12 to 15x. The implied Panera EV of $10.8 billion to $13.5 billion. So the football field summary has a DCF anchors downside protection, trading comps define market ceiling. The precedents reflect control premiums. So for the validate sensitivity or some sensitivities are the plus and minus 1% of the WACC, which is turned into the plus and minus of 12% EV, and then the terminal growth from zero plus and minus 0.5% to 8% EV, the BPS margin from plus 100 to plus $1 billion EV, And so if we look at the difference between the strategic and financial buyers, the synergies or the synergies from the strategic side is there's a procurement and supply chain from roughly $120 million to $150 million. Digital and loyalty scale, which is scaled at about 50 million to $75 million. A G&A leverage of 30 to $50 million. So from the financial buyer or the KKR perspective, there's a limited synergy. It focuses mainly on execution and margin discipline. And the bid strategy is there's an opening bid at $11.5 billion, which is roughly 12.8x of the EBITDA. There's a target range at 12 from 12 to $13 billion of EV. The walkaway price of $13.2 billion, which is 14.7x of the EBITDA. And there's a moderate leverage and 10% management rollover. And so the final recommendation, and this is basically the last slide. KKR should pursue Panera aggressively but remain disciplined. So a 12 to $13 billion enterprise value maximizes risk-adjusted returns while avoiding overpayment driven by speculative strategic synergies. If we go back to things that it's asking, so we can if we look back at it, it says deliver full valuation. So we did that. We This was the snapshot that we looked at, and then this is the framework that we use, driver. Okay, so if we look at it carefully, if we go back, we did these. Okay, it looks like we got everything. And just to clarify once again about the ending, but the conclusion is that KKR, which is the financial buyers, they should pursue Panera aggressively, but they should remain disciplined. And 12 to $13 billion enterprise value maximizes risk-adjusted returns while avoiding overpayment driven by speculative strategic synergies. So there's synergies that can get in the way of it, and then if the financial buyers just pursue it properly, then it should be fine. As long as they pursue it aggressively, but stay disciplined and not over not overbuy it and not overpay for something that doesn't need to be overpaid for.